Welcome to the Brokershop Podcast, where we broker ideas to help you execute and thrive. In today's episode, we have Rob Piccolo from AFR. Rob, how are you doing today?
Having a great Friday here.
I love that scenery behind your office there. Tell us, where are you located?
I'm 2 days into my new office here in Tampa. Our company was headquartered in New Jersey, but we opened up an office down here where I live in Tampa, and we're just getting. I don't have anybody in here yet. It's just me, but so it's a little bit of a barren office right now. But it's our second day in. I'm excited to be here. Great view. This is you can kind of see Clearwater in the background there.
Yeah, I was going to say, that looks like Clearwater back there. And I guess you get the perk of it's almost like when you first move into the college dorms, you get to pick your room, you get to pick the bunk first. So,
yeah, well, there's offices over here I'm not taking because they don't have as nice a view as this. So I'm going to sit on the floor until we fill these seats. I'm going to enjoy the view.
Nice.
That's amazing. Well, new office, that means you're definitely growing. Tell us a little bit more of what you do at AFR.
Oh, AFR, it's actually it's a long story, so I'll keep it short. But AFR is where I grew up and learned the mortgage business. So I started at AFR in 2003 and ended up, doing a little bit of everything. Ran an origination group. I was an LO and ran a small team. And then ended up building up a solid group of something called Internet Marketing Group, which wasn't that popular as it is now, but back then we were online and trying to drive leads and do that back from 2003 to 2008 or so during the crisis, and then I got an opportunity to buy into AFR in 2008 when everyone was running for the exits. I decided to ask my family and everybody every penny I could possibly borrow and buy into a mortgage company in the middle of the crisis. So I was able to do that in 2008 and ended up selling the company back to its partners in 2017, 18-ish, and left and went to a large publicly traded originator and servicer. And then after we sold that company, I ended up starting a brokerage. And the long story is to say I've come full circle. And then from friends and people I've met along the way in this industry, had an opportunity to come back. And there was a fund that was looking to purchase an originator, and we got to buy AFR in February. So we got to purchase AFR back in February. And since then, I've taken on the COO role, but oversee basically all aspects of the business right now. Obviously, our wholesale and correspondent divisions, all of capital markets, all of marketing, and just basically the main businesses of the company I get to oversee currently.
That's amazing. That's a great experience, a long story that you made it short. Thank you for giving us that. What does AFR do differently to support their brokers?
Oh, geez. We do a lot. So we're known for niche products, right? We're known for one-time close construction loans, renovation loans. That's what we're known for. That's the company we purchased. Where we're looking to go is we love that business. We want to keep that as a baseline of our business, but we want more, right? We want more. We are really working hard right now on this kind of drive via capital markets and secondary markets and really bringing in the best pricing and passing through the best execution in the market to our broker clients and giving them an insight of why it's happening, why pricing is where it is, why certain rates are better than others, and give them, the tools that are needed out in the market so they can talk intelligently about what's going on. Because everybody, it's the first question anybody asks when you walk into a real estate office, right, is, what's going on with rates? And a lot of times don't have those answers. Where here you can come in, and if you hang out with AFR and you're a partner of us, you're going to see over time, you're going to start to receive information regarding what's happening in the markets, what's happening with rates, and you have an educated answer when you get that question. So, the main thing that we're doing right now, what we do differently is like we listen. Like I'm 4 months, prior was at a brokerage, and working on the non-Del side. I owned my own brokerage prior to that. So I don't think there's another company that's out there that has as much connection to the front lines as AFR does now.
I love it. You know what it means to be a broker, a non-Del, all of it. So you know what it takes, and you know what it means to support a broker. So we're just getting to know AFR, and we had a great experience so far when it comes to. I've been in a couple of Facebook Lives that you've been a part of, and I've learned a couple of things from you. And as a loan officer, I have struggled with the secondary market. Like I get the questions all the time from my clients. Hey, where are we standing now? Where do you think the future is going to be? Is it the right time to buy? Is it the right time to lock? And I've always struggled with giving a educated answer. So, Rob, I wanted to ask you, you're the expert at it. What is the mortgage secondary market and how does it function?
Yeah, so it's basically just where you go and turn and sell loans, and mortgages in itself are just bonds, right? So they kind of trade along with bonds. So if you know anybody in the industry, you generally are watching like the 10-year Treasury, and you say, oh, it's like the 10-year. If it kind of moves where rates go, and that's what you pay attention to. The reason is it's all based on duration. Like, what is the timing of the bond? Now, you might have a 30-year mortgage, but that loan, how many people do you know kept a 30-year for 30 years, right? It doesn't happen. It's usually that duration is between 7 and 10 years, more likely 7. Maybe the cohort that is sitting in, the 2s and 3s now is going to last a little longer. But basically it's just a play on yield. Somebody's going to pay for a certain yield of an asset. They're going to try and buy an asset at a certain price and obtain a certain yield for it. And they're going to pay a price for that. And that's going to end up where rates are currently. It's going to depend on how much of a price they're going to pay for that. So the secondary market basically is just taking the assets, turning around those mortgages that you're creating and selling them, and having an investor who's willing to pay a price for that. And you'll see that all the time. You get a lot of questions of like, well, how come, you can't just keep going higher in interest rate and get more premium, get more yield spread. It doesn't work like that. Eventually, as you keep going higher, there's less of an opportunity for that. And for more, who's going to pay you 5% for a loan that might pay off in a month?
Makes sense. And who are the key players in the mortgage secondary market? Who are those players?
So there's twofold here. Well, maybe threefold. So we'll say the guys that back it, like, so 90% of the loans are going through a Ginnie Mae, a Fannie, or a Freddie, right? So they're going to those types of securities, and that's backing. So Ginnie Mae is your FHA loans, your VA loans, your USDA loans, and Fannie and Freddie are self-explanatory with their conventional loans. They are the major players, in secondary markets. They're the ones that are backing pretty much everything right now. The second part of that's the investors. The people that are actually investing in the MBS are incredibly important. Now, Fannie and Freddie are the ones, and Ginnie are the ones that are splicing and dicing and creating the securities or backing the securities that are being created. But really, the pension fund from Idaho, Japan, these other places who are buying the securities, actual MBS, they're a huge player in the market. And we're seeing that people who want U.S. debt also love mortgage-backed securities because you generally get a little bit higher yield, yet still have that full pledge of the United States government behind the bond.
Wow. Okay. Now that makes good sense. And whenever the 10-year Treasury bond moves, what makes that move?
It's supply and demand, and obviously where inflation is. There's a lot of dynamic to that. So it's a supply demand curve. Right now, it's kind of weird because our short end, so the shorter term bonds are actually are yielding a little bit more than the longer term bonds, as you see that now. But it's based on where the market is going and what the anticipation is where rates are going to be at that time frame. So it's mostly supply and demand, and where people need to park money and feel comfortable that money is going to be worth more when that bond is done, when that bond has come to maturity, right? That's the key component. Because if you keep it just in cash, it could potentially be an issue, right, in the future. So these other entities, other foreign entities, they're huge buyers of treasuries and MBS, and they're like I said, they basically make the markets for us. So that's mostly supply and demand there.
Makes sense. And excuse for my lack of knowledge here,
Sure.
But day traders, how do they impact like the trading of bonds? Like,
Yeah,
I've always wondered that question.
I would say more, not really day traders. I would say the algos. You see, like right now, back before, like I would say when I really got into trading MBS and dealing with hedging and all that other fun stuff that we do in capital markets world, there wasn't as much movement or velocity of the movement as we have now. And you see, when you hit certain technical levels, like you can tell when all of a sudden you hit something and you go under 100-day moving average, or you go under a certain technical threshold, it's like floodgates open and you see this huge move. So you really haven't seen that until recently where these algos kick in and it's like, all right, when something gets at this price level or someone gets here, this is where the money starts to pour in. And you see a lot of that now, more so than you did in 2010 and 12.
Got it. At AFR, I know that a leverage that you have is the knowledge that you have in the secondary market. How do you guys capitalize on this for your brokers?
Yeah, so we think of it differently. Everybody else does it this way. They take in all the loans. They price the loans conservatively, they take them all in, and then they turn around and go like, all right, how am I going to slice and dice these loans? We have a little different philosophy on it, and we turn around and we go to the secondary markets and like look for what we can arb or look what we can execute, fantastic, that is not maybe getting a lot of volume right now, and then turn around and pass that through immediately to our brokers and correspondents in pricing. And there's risk in some of that as well. Like some of the markets might not be around, by the time the loan closes and is ready for a settlement. But we think it's worth it, thinking that, we can hedge as best we possibly can to the markets. There's things out there and stories out there, we call them stories that, out there that really benefit the broker and the borrower. And we want to get that price and execution passed through. It's kind of like a self-fulfilling prophecy because there's these opportunities in the market. But if I waited to gather enough of it just, coincidentally, I wouldn't make as much money or have the opportunity to make as much money or have as much premium. Here we go, look, see what's going on, pass it through, try and get as much of it as we can. So that way, obviously, the only way to get it is to price it more aggressively. And that passes right through to the broker and their borrowers.
Does it take a big team behind the scenes to accomplish this?
Yeah. It does. Well, no, it's a really smart team. I have a really, really smart team, and they're getting smarter every day. So, the key component, one of the things we do is one of our core values here is this relentless pursuit of better. And we use that a lot, for our team members, because like there's no end game in getting better, right? That's why we don't say like to achieve something or be the smartest you could be and that's it. No, we want to continue to get better. Even if you're the best, like there's a room for improvement. You can get a little bit better each and every day. And our team's doing that, and it shows in our execution.
That's amazing. That's amazing. I know Mac has a couple of questions for you as well. He's our chief sales officer here at Safe Trust Mortgage, and he leads our loan officers team. So he talks about pricing every single day. And he used to be an account executive as well. So Mac, what we got?
Yeah. So in regards, so a couple things that I hear often in regards to like my loan officers is them understanding preemptively how to start positioning themselves, whether it's rate or structure on files. And how much does risk go into play for AFR in pricing? Like, do you guys have additional adjustments, or is the book of business that AFR takes on and the risk of its portfolio, does that affect its pricing?
It does. So there's always risk. There's always risk in what we do. We have something actually created in terms of value at risk, and that's something that we excuse me, my camera just went a little funky on me here. So there's something called value at risk. And we do that when we take in locks. We know how much potential value could be at risk based on our hedge, current hedge positions. And then we match up our hedges and do everything we can, there's no like long-term risk when we take in loans. We price them accordingly. We have our set margin. And when we can turn around and find a way to hedge it or put it in the secondary markets and basically it's called selling forward the trade, we sell forward the trade and de-risk any potential market moves at that point, which is why it's so important when you lock. One of the messages I wanted to say today was for LOs and anybody else. If you want a company to have the best price and you want a company to like really work with you and pass through all that stuff that is amazing in the secondary market through to your pricing for your borrowers, is to let them know when your locks cancel. Like when there's a lock out there and you might have locked it and 3 days later the guy says, hey, go scratch, I'm going somewhere else, and they're gone and you have no chance of the app, or they're denied or they don't send you the documents. Don't let that thing linger. Let the lender, doesn't matter if it's us or anybody, to have the best execution. Knowledge is everything. And for us, we just want to know that we don't have to hedge that loan anymore. So then, it's more accurate when we get to the end of the lock duration. And then the next loan that comes in, we can pass through a better price because we didn't mess up on that last one that we thought was going to close but never did. So, for us, the risk always lies in rate movement. It's like that's the one thing we can't control. We're hedged for it, but if rates move a significant amount, we have to be able to accommodate either through float downs or just getting these things cleared quickly so you don't have to worry about it.
That's interesting.
I was going to say that is actually a phenomenal pro tip for a lot of loan officers out there. That is actually something that I learned as an account executive, that the lenders hedging their loans. If you have a lock that's blown, it's that much more important to get it canceled, so that way they can rehedge their funds. So thank you for that pro tip. Hopefully a lot of loan officers are listening to that, because that benefits the entire broker community. If we can just be that much more disciplined with our locks. Now in all this talk about locks and risk and mitigation and hedging, how is AFR adapting to AI with the secondary market? Is that a thing? Is that possible for AI to have predictive, rates, predictive rate predictions or whatever? Like, is that possible for AI to help you guys hedge the market?
Yeah, it'll get there for sure. We're not there. Nobody's there yet. Like, there's plenty of things that we're working on there to fine tune it. It's hard to get like your hand off the control though, right? Like, you don't want to and it's definitely smarter than me, but like if it messes up, like AI is not getting fired like I am, right? So like, you want to make sure it's right, and you want to have full control. But yeah, sometimes it's interesting because the data, I definitely want to talk through that point. The data and the information that machines will be able to do for us are going to do amazing things, especially in optimizing execution. Like, how do you slice and dice what the true prepayment numbers are going to be for this, like based on what's happening in the market, and have like a live, living, breathing prepayment model being built out. Like, AI is going to help a ton with that. But then you have other pieces to it. Like, it may, tell stories that people don't want to hear. And that could be, potentially, maybe a certain class of person or demographic is prepaying or not prepaying, might get worse rates in it. And so you have this like machines versus potentially fair lending issues that you have to pay attention to. So it's hard to like just let it go and run, because you may be by accident pricing things differently based on class, because that might be what the data says.
Yeah, and that's what because I believe it was the episode when we had Russell Petty on it, and we were diving deep into the AI, and that was something that was I don't want to necessarily say concern, but a point of emphasis for me is the fact that AI learns from biases, right? Like, it'll take information and studies and examples from anything and everything to form its opinion and facts and data, right? So that's the one thing that can be skewed, because, like, for instance, beautiful example, you being there in Florida, Coral Springs is going to be, that market is going to just produce different products in itself, to where the APRs are different than like a Bartow, right?
Yeah.
Or you just have those different dynamics. So hopefully AI gets it right. Hope that's what we hope for.
We hope so as well. But we're definitely going to coexist. We're going to adapt to it as brokers and as lenders. And I think definitely see us coexisting along with AI.
Do you guys use AI at all right now for AFR?
Yeah, we do. Yeah, so we do. And we have like, I would say probably like 10 different projects running. So we're excited about it. We have a lot of emphasis around the manufacturing process. We think that's just the area that, like, data's data, the input of income is input of income. And we think eventually, that's going to take over a large majority of our manufacturing process. Now, our team members, like the thought isn't, AI is going to replace people. No, AI is going to enhance people. So now, underwriters still need to be able to accept like Fannie and Freddie. They're not like, oh yeah, let the robots do it. Right. and HUD, they're not okay with it. So it's the idea is there's going to be people there, but can we optimize it? Can we go from the 2 to 3? That's industry standard of underwrites, maybe even 1.5 is what's the standard, to 8 to 9 to 10, and really drive the cost to complete down so we can pass through a better price to you guys. That's our goal. So, our AI pieces are more so focused on the manufacturing process. answering questions in terms of guidelines, that part's being built, escalation processes, having an understanding, an AI bot to kind of create the pathways when there's something goes wrong on a file, that it gets to the right person that can handle it. Those are the things we're working on. In the secondary and capital markets side of it, like the optimization of what's called pooling in our business, there's a lot that goes into it. There's slotting of coupons. There's, where else one loan can go into two different types of coupons. There could be different MSR values. There could be different spec values. There's a lot that goes into it. So, we're working on that as well.
That's amazing.
Yeah, 100%. And then, oh man, it was a great question too. It was just right there. I'll go ahead and let you go, Marcel.
No, we as brokers, we do need our wholesale partners to help us out with technology, and we believe it's gonna come from our partner lenders. Of who I see you guys as pivotal to our success as well, because you guys have the bigger teams, the experience to walk us through the next 5 to 10 years of all of these AIs that's coming out, and that's how we're gonna coexist together. And then we do see you guys as the leaders on it, because we as brokers, right, we're solely focused on origination, processing, closing, funding. And then we see the biggest players in the industry leading that innovation.
Definitely with the innovation. And that's what had slipped me for just a moment. The a lot of people or loan officers may believe that with that beautiful, shiny price that's super competitive, you are then sacrificing maybe technology, maybe communication, maybe service. Outside of the great things in the secondary market and what you guys are leading with those initiatives, what can we look forward to that you guys won't be sacrificing to still deliver this great price? Like as far as communication, service, and underwriting.
Our portal, we think there's a lot of value in our portal. So, we have a proprietary portal. We built it ourselves. This isn't an Encompass bolt-on. Like we knew, for us that you guys go into the same portal with like 10 other lenders. You have like, UWM and then everyone else, right? So, or Rocket and everyone else. So like that part of it, we know that the portal is a place we want to provide the most value. We think that if we can keep the communications within the portal, we can keep our knowledge base, like what we're delivering in terms of knowledge in the capital markets. You guys can, ask questions within the portal, and creating something that most places don't have, and that's transparency when things go sideways or things go wrong. Yes, that does happen. Like nobody's perfect. Like things are going to go wrong. But the question is, like, how can you make a broker and your partner feel comfortable that the answer is coming? When is it coming? Did you go the right pathway? What we're trying to avoid with our systems right now is what we call like the blasted escalation and CC tree, right? It goes like, all right, the person didn't answer, so I'm going to CC 12 people, and then they didn't answer within 5 minutes. I'm going to go ahead and CC the other 20 that I know that work there. I'm going to put the CEO on it, and myself, and everybody else on it. That we want to avoid those situations. So, our portal is a place that we, both from the borrower perspective, we represent our brokers, properly within the portal, and then when you go into the portal, we want it to be a place where you look at it, what's happening with your business with AFR, how many loans they have, how much opportunity for revenue there's going to be. You understand locks are expiring. You understand, anything with a loan in any situation or any escalation that you have, you'll see that. So we're building that portion of it. And we think that's the most important piece to the puzzle, is the communication and transparency with our partners. One of the things that you talked about, earlier, about getting the loans in and your team getting locks, like it's hard to get a loan. Like I talked about it with Jonathan during the AIM podcast, and I think that's taken for granted of like I was out there, like it's freaking hard. Like it's hard, and you get a loan, and then you turn around, you have 250 choices, and like you chose us. Like we have to take every loan in and feel that way. Like, holy cow, we are grateful and lucky that you chose us and trusted a relationship that could easily go south, and you can never get another loan from that person again if we mess up. Like we have to take every loan that way, and that's what we're building. We're building it with that feeling in mind, saying like, what would have been great when I was originating? What would have been great if I had a chance to know this? If I knew that, this one went awry, and we're taking every bit of the feedback and every bit of things when they go wrong. Like that's the whole point of the escalation means, and why like UWM's like CR piece is so great is data. Then you know what goes wrong, and then you can start working on fixing those items and providing them up front. And that's the key component for us.
I love that. What other things have you learned and you have taken from other partner lenders that do great things, and then you put them in AFR?
A lot. We learned a lot. Like I said, I think we have an edge on some of the niche products in capital markets. We think we have the best in the business there. We love the approach. Like we talk about all the time. Like that's why we're going the route of capital markets. Like there's places that offer amazing coaching for sales. Like I'm not a sales trainer. I'm not a sales coach. Like I'm not going to go out there and make you feel like I'm going to run through a wall and get loans. Like that's not it. I'm not going to do that part. I'm going to try and get you smarter. I'm going to try and get you into a spot where you are an expert in the field that you want to be an expert in. And for us, it's capital markets. We take on those things from them, how they train, how they do it, and how they put the image out there. We love that. Obviously, technology side, there's a couple guys that are better than everybody else. Rocket and UWM are better. We take, I love, like I said, I used to do some loans with Rocket back in the day. I like their system, like their pricing, like their ease of transition for a customer from their beginning of the portal all the way to servicing. Love that concept. UWM CRs, like I know they drive other people nuts. We think it's like what an amazing way to be able to like just know this is what I have to do. This is where I go. Just knowing this is what I have to do to get an escalation. This is what I have to do to clear something. Like having that clarity there. And then we do a lot of like what we don't like, from different lenders. Like there's a couple of major lenders. I hate their portal. So like, I know I don't want to have that portal. I can't stand the portal. Like I can't stand the way they upload conditions. I can't stand the way I can't see my pipeline. I don't have a dashboard. I can't stand jumping through hoops to try and get better pricing. I don't like those things. Like I want, so every lender has a bunch of good and a bunch of bad. So we're trying to peel it away and get only the good things that we think from an origination standpoint are valuable, and push that forward in what we're building.
Excellent.
I love that, Rob, because that is ideally what I know coming over as the chief sales officer with, just under 7 years experience performing at United Wholesale Mortgage. That's where my mindset was, is all these brokers, all these LOs, all these experiences, business models, lead generation types. What worked for all these guys? What didn't work for these ladies? Like what made their businesses, like what was their culture good? Did they have a high turnover rate at these companies I help manage? And I think that we've been able to find a very, very good balance of knowing what not to do and what not to go after and spend our time on, and then versus what to invest our time and into our people mainly, really. Yeah. But I love if that's your mindset, you guys are golden.
You can't be the be all for everything, right? Like you sometimes you just know, like, hey, I'm going to tip my cap. I'm not going to have 5,000 brokers in my Tampa office and going to have a incredible, rah moment for everyone and do this amazing show. Like we just won't do that. Like I'm tipping my cap saying that's over there, stay there. That's amazing. We love it. We're not going to, that for us, the value isn't there to try and do something like that. So why try? Like, I don't want to, do it poorly. So we're going to focus in on what we're really good at and take the bits and pieces that we love and make sure that we don't incorporate things that we hate, and that's it, and build something that is for the broker. Like that's the main driver here is that it may not work for every broker. If a broker calls me up and says, hey, listen, I need you to mail this disclosure out immediately and have this guy's got an ink sign and he needs to FedEx you back his documents that he printed, I'm out. Like I can't build and scale, a platform like that. We have to work with people that get it, that want to work with the stuff that we're building and fits. And we think it's going to be where the business is going and where the market is. Listen, loan officers are still getting older. I love the broker community. I love the vibe and like the age of the broker community. It's younger. It's like, it's vibrant. And they want to get better and they love technology. Like we're in, like, that's what we want to like buy into. So we're excited for that and the opportunities that we're seeing right now, especially, that broker community right now, that's part of our investment thesis of AFR was like, holy cow, they have thousands of brokers signed up and nobody sends them loans. They only send them the niche loans. Like, this is incredible. We don't have to go out and get new customers. We have them. We just have to convince them to send us a regular loan.
Right. Amazing. No, this is a perfect question. You mentioned the broker community and how important it is to the real estate market. Where do you see the broker community in the next 10 years?
I think it's growing to kind of pre-crisis market share. Could it be 50% of the business? Sure. We think it can be. I think that last mile of origination is so important, and to kind of pigeonhole yourself into one entity, where here, like, the broker community is great because, like, I'm going to work my ass off to try and get that loan. And the next guy, Chris Vincent at Windsor is going to work his ass off. Matt Ishbia, we know, is a lunatic. He's going to work his ass off to get the loan. Like, everybody's competing and vying for the loan. Like, I just feel like that channel, like, is just going to continue to get better and better and better. And we're working to try and earn your business. When people are earning the business, then, like, there's no one's content. You can't be content and just ring the register. We're always getting better and continuing to improve. So, we think the broker market, and that last mile origination with people with optionality and choice is going to win over the next 4 or 5 years.
I love that.
I really like that. Rob, I know we've been spending about half an hour together here. I love your authenticity. I love what AFR is doing and what you guys are focusing on. And a couple more questions, and then we're going to get out of here. What do you predict for the future of the mortgage secondary market?
Technology is going to have a play in this. There's going to be more optimization going forward. You're going to start to see, and I think, probably segue to some other questions that I'm sure you have, is just maybe some blockchain opportunities, securitization opportunities. There's like some, there's some levels within the mortgage secondary market that has, some of the premium kind of baked in because they're passing through hands. Like, we take a security, we take a trade with a broker dealer. There's a little bit of margin for those guys, and then they're delivering. They have investors that are buying into the fund. There's a little margin for those guys on the front end. Like, there's a little bit of money going in. So technology is going to help bridge the gap from the mortgage onto the security, and the people that are investing all being in one platform and having it be very fluid. And payment comes in, remittance goes out, goes to the people who invested, and start to move out the middle baked part of that, because that could equate to 40 to 100 basis points based on what some of the data that Mike Cagney has provided from Figure and what they're building. So that part, I see that having a big effect on the future of the secondary markets.
So kind of like, if this, then that, and just routes it more directly to process that action versus the middle.
Correct. So instead of, you have a security on the chain, and when a payment comes in, it automatically goes and gets remitted to whoever invested in that without any human interaction. Right now, there's a lot of human interaction that clip the coupon, we call it, right? So you might start at a 6.5 coupon, maybe only 5.5 of it ends up in the investor's hand. There's 100, basis points of rate that's going other places. So maybe you can remove that layer or a couple of the layers and provide a better price. So have that investor direct, still have the same backing with Fannie and Freddie and everybody else with HUD insurances, but just have it, not have to go through so many hands when it's getting passed through.
Amazing. No, I've heard about what Figure is doing, and I've actually looked into it. Does this mean that regular people like you and I, Mac, can invest in the secondary market in MBS? Is that what Figure is trying to do with blockchain?
Well, you could. So you could do it like through your investment, people right now, but and through different funds and different ways to invest in MBS. But yes, the idea is to have a direct pass through and have a little portion of a bunch of securities, so you're de-risked, right? So if you have something like you have $1,000, it doesn't have to be in the Jones loan. The $1,000 could be, $1 and 1,000 Jones loans.
Amazing.
That's actually revolutionary. It really is. I know wealth managers, if they're listening to this, they're probably going to start doing it.
You're like, wait a second. Yeah, listen, there's a lot of stuff, like, there's a lot of things you'd want to do, and there's a lot of things you want to do in mortgage too, but there's rules, and the government doesn't move very fast. So I'm sitting here talking about AI, but it's still hard to get like an e-note sold. So it's it all makes sense, right? We all know that like title and all the recording of who owns what should probably be on the chain, right? We know that it should be, but there's resistance. It's a fee income for a bunch of municipalities like that. Like it's just hard to break through those kinds of things with technology overall. So it will take some time, but once it starts to happen and there starts to be adoption, you're going to see a significant shift.
Amazing. Speaking of cost of borrowing, the person that sets cost of borrowing is Jerome Powell. When is he going to make the first rate cut? What's your opinion?
Man, I think there's going to be one this year. I think as soon as we see any break in the labor market, we'll see the opportunity for a move. So I think that happens this year. I think we see one cut, and I'll say it on camera. I think when the cut happens, it's going to be violent. So the cut won't be big, but what happens to mortgages and the rates in general, we're going to see a significant move in a race, I think, to lower the long end. So I think once that thing, everyone's just waiting for that first one. Yep. And then we're going to see, okay, like all signs are, I'm not saying it'll last, but I just know it's going to be a violent move, and the velocity of it's going to kind of make sure that we're all going to try and be prepared for it.
I agree with you. And we've seen that policy mindset shift from Jerome Powell. Like recently he said, hey, he did comment on there will be a possible rate cut this year. We've never heard him before that. And that was very exciting for me as a loan originator to hear that, right? Refinance opportunities, more affordability coming along our way. And we're getting excited for it. We're definitely getting excited for it.
Now this is my question to you, Rob. Initially, so when the rates are, let's say they announce a rate cut, right? Why is it that the pricing gets worse before it starts getting better? And sometimes that after that announcement, the sting of the rates ticking up just a little bit of that pricing worsening can last for a second. Like you're thinking rates are cut and going down, but then as a loan officer, you're pricing loans and you're seeing, all right, 5 bips here, 7 bips here, 12 bips here, going in the opposite direction before they start dropping. Can you explain a little bit of the mindset behind that, or maybe why we've experienced that in the past?
Yeah, it was the mechanics, right? So the Fed controls short-term rates, more so car loans, the prime rate, how HELOCs work, credit cards. That's like the focus of that short-term rate. But it has effects on where things are going. So we, a lot of times in mortgage world, we care about like what Powell's saying. And if you watch any of my stuff or if you see on Facebook, whatever, I'll comment on it all the time. Like Jerome just ruined the day. Like Jerome went out, like, here we go. We have momentum. We saw this. And then he just ruined it because he's going in and talking long-term. Mortgages are, like I said, more longer-term duration. So where the market's going, inflation has an effect on this, and how it drives rates. And what they're doing now, what we'll see for LOs out there just in general. So we see a rate move, the first cut. What that's saying, and that is signaling that there's weakening in the economy. When there's a weakening in the economy, that means longer term rates are going to start to come down. That there isn't going to be as much growth, and there's worry there, so rates are going to come down the long end. That's going to spur it. It's going to be like, okay, the Fed finally sees it. Okay, there's cracks in the labor market. All right, now we're going to start to see the long end get lower, and he may only move a quarter in rates, right? If he moves a quarter in short term rates, but what we'll have from the origination standpoint in terms of opportunity is we're going to have an opportunity where the short end is still going to be really high. You might see this falling long end. So your credit cards are going to be at 21, 25. I think the average is like 22.5% or something for that. Your car loans are still going to be at 9. Your HELOCs are going to be at 9 and 10 that people took out still. And their fixed seconds are going to be at 9 and 10. And meanwhile, maybe long-term rates hit into the 5s. Now you start looking at a 3.5 or 4% first loan that is through the first, 5 or 6 years of, amort. And then you can sit around and be like, well, maybe we can pay that off and take all this debt that, we know Americans, we love debt. So like, take the credit card debt, you could take these things and start paying those things off. So you're gonna have this like little window of opportunity where the short end is going to be higher still and the long end drops. And there's going to be a significant move. I don't see like refi wave, but I see like debt consolidation wave because the signals are there that debt is significantly higher than it's ever been. And equity is in a place that it's never been. There's tons of equity. So you kind of match those two and you have a home run for us.
I love that.
We know who the best in the business is for debt consolidation. That's the guys down the street. We live in Michigan, so in downtown Detroit. What message do you have for loan officers to get ready for debt consolidations? Because I agree with you. Debt is at an all-time high. How do these originators get ready for debt consolidation?
Yeah, how do they compete against the Quicken Loans retail, that's all they're going to be calling,
Yeah. Well, I mean, one, they're going to be doing your loans for like 300 bips less in margin. So like you can certainly compete there because we know their margin levels. They're like, and that's the easiest thing to sell against, right? They post them. Like you just go to their quarterly earnings, be like, oh, by the way, I run my business at 200 basis points less than what these guys do, or I run my business at 300 basis points less than what they do. Look at their earnings, so you're going to be able to provide a better product because it costs a lot of money for them to get the Super Bowl commercials, and all commercials are expensive and branding's expensive. They're all over everything. That doesn't come cheap. So, there's going to be opportunity to pick them off. I think finding and making sure you're prospecting now, like that, the key component here is like when you're looking for the person, when this happens, you're too late. Like people are spending the money. So you should have a database that's ready to go. And you should be talking to your customers and saying like, hey, how, you bought a house 3 years ago. By the way, you have $40,000, $50,000 of equity. You have $100,000 of equity. How are you doing on credit cards? Is everything okay? Like, are you being able to hold the finance? Any major expenses pop up? Getting that database prepped and ready. So that as soon as it hits a certain level of rate, it makes a lot of sense to consolidate for them. And so you're having those conversations, getting them ready to just because it's not a loan today, it's a prospect for tomorrow. You got to prep and be ready. So they're thinking of you when you're doing, when there's an opportunity to refinance versus thinking of the guy they saw on TV.
I love that. Here at Safe Trust Mortgage, we always say we as loan officers, we're debt managers as well. And we're just not, hey, we're here to help you purchase a home, but we're here to help you manage your debt along the way. And that's what we can get paid for as well, by managing debt. Rob, it has been a pleasure speaking with you.
Likewise.
Thank you so much for coming on the Brokershop Podcast, and looking forward to doing business together. We're definitely going to sign up with AFR and take advantage of your products and your pricing. And thanks again for your expertise. We appreciate you coming.
Appreciate it. Thank you very much for having me. You guys are the best. So thank you, and looking forward to seeing that broker application come through.
Absolutely. I hope you have a great weekend. Take care.
Thank you, Rob.
Thank you. Take care, guys.